Did you know that e-commerce brands are leaving thousands of dollars on the table in ad refunds or optimizing their accounts to avoid ad refunds? Hi, I'm Stephen Brown with Ledger Gurus, and with me today I have Kurt Bell from Dash.fi. Kurt is the Director of Enterprise Sales at Dash.fi, and we're going to talk about advertising refunds, or even more importantly, how to avoid them. Kurt, thanks for joining me.
Yeah, Stephen, great to be here. I've been looking forward to this and appreciate you making time.
Yeah. Tell us a little bit about your journey to e-commerce. How you got into this part of the industry. Give us your background.
Yeah, happy to. So I've been in the e-com sales space for about coming up on 6 years since 2020. And I kind of fell into it by happenstance, to be honest. I was fresh into the software sales scene, was working for a different company here in Utah, and was someone I had gone to college with at Weber State had just started a new SMS marketing platform for the e-commerce scene called Via SMS. So brought me in, first 5 or 6 employees to help build out the sales team there, scaled it to about 120 people. It was a great experience. And more than that, I just fell in love with working directly with founders. And so ventured out of ecom after that for a year and just missed it way too much. So when I met Zach Johnson, our founder here at Dash, and had the opportunity to come back, that was about 2.5 years ago, and haven't looked back since. Just love the opportunity to deal directly with founders, building cool businesses, and get to work directly with them.
Now, the reason I wanted to have this conversation, I met one of your colleagues. He told me about what you guys were doing, and I wasn't aware of the issues around ad refunds. I have been aware about the issues with shipping, but ads, I want to dig into this. So how common are refunds or issues with ad accounts?
Yeah, it's more common than you would think, Stephen. I think what's interesting as we speak with brands, I think the overall sentiment is that their ads are running incredibly efficient. They've put protections in place. They don't believe they'll have a high volume of bot traffic, fraudulent traffic, invalid traffic coming from their Meta and Google ad campaigns. But it's been interesting as we've gotten into it and have 100 clients plus on this platform of the ad pay protection, that the average is in between around 3 to 4.5% of a company's spend is being wasted on fraudulent or invalid traffic. And so it's more prevalent than companies think.
And is that what most of this is bot traffic, fraudulent traffic? Is this where the problem spend comes from?
Yeah. There's without getting too far into the weeds, there's about 40 different data points that we're looking at as a company, but it essentially comes down to bot traffic, click farms, but also can be as simple as out of geo, where you're targeting people specifically here in Utah, but you're seeing traffic come in from Colorado, Idaho, Arizona, etc. And so it's really, we're looking for the parameters you've set in an ad campaign. The traffic that's coming to your site, does it fall within those parameters or does it fall outside of it?
Gotcha. I actually have a story. I'm sure you have one too, but I had a customer, a big customer. They had their pixel get taken over by bots and their Facebook pixel. And this was about a year and a half ago. Their ad spend just started to deteriorate. They started digging in and figuring out what was going on. And when they got in, they're just it was, the ROAS was just terrible. They ended up deciding, I wasn't super involved, but they ended up deciding to start a new pixel, which, was a nightmare. So they had to completely reboot, retrain it. It cost a lot of money they lost, they didn't really lose sales, but they had a huge loss for about a 1 to 2 month period while they were pushing to get that pixel retrained. So I have seen, I guess, what you're describing, but it sounds like this is a common, at least a smaller scale with a lot of brands.
Yeah, correct. I think, the idea is it's a product we hope the amount of fraud traffic coming to their website decreases over time. That's our hope. We don't want companies to continue to have high percentages of fraudulent traffic. The hope is by, the solution we've come up with to help solve for the problem, as well as Meta, Google, these companies are making edits on their end and adjustments to help prevent it, that ideally that number decreases over time. That's the end goal on our side. It's not to profit from the from the fraud traffic. It's more to provide a solution that solves for it.
I have a big question as you think about this, and maybe you'll have the answer or not, but Meta and Google, these guys are huge. They have huge technologists. They have AI. How in the world are they not filtering out this fraudulent traffic automatically? Do you guys have any idea why that happens, or is it just a big black box?
I think it's honestly a big black box. I mean, we actually, I can send you the link after this, but there was a CNBC article released last week that in 2024, 10% of Meta sales came directly from fraudulent ad campaigns. Is what it was. So, I mean, when you
Good
consider
heavens.
10%, or it quotes it, 16 billion came from running online ads for scams, banned goods, etc. So, um, it's a problem Meta's proactively solving for, but 10% of their revenue coming from fraudulent ads. If the ads aren't being protected, then what does that say about the traffic coming into those ads, right? So,
Yeah, it's an economic disadvantage for them to do the right thing. So they're probably not going to invest a lot of time in that. If somebody was trying to, so let's say you get fraudulent traffic. I gave you the example of an extreme example of one of my customers did. But my understanding from you guys is that you can request refunds. How does that work?
yeah, we've kind of taken a two-pronged approach to it. Number one is creating what we've, IP exclusion audiences within the Meta and Google ad account. So if you've got, a list of X amount of visitors that came in over the last 30 days that were deemed fraudulent and invalid, first off, let's put those in an audience, exclude them from future targeting. So you're not paying and running ads to target people that we know are bad actors or are, would really lead to invalid traffic. That's step one. That's been very successful, and that's where that 3 to 4.5% savings has come from there. Step two is then through the typical support process with Meta and Google, requesting a refund for the traffic that did make it through, to be able to request a refund for that spend that was wasted on that traffic. And I would say that's been less successful than the proactive IP exclusion, but we're still seeing some sort of refunds in the form of ad credits hitting the ad accounts for these companies.
Why is it hard to get the refunds? Are they just resistant? Are they requiring a lot of evidence? What is it about that process that is problematic?
All the above, right? I think Meta and Google aren't companies that are looking to give back money if they don't need
Give money
to,
back,
right?
yeah. Yeah.
And then there's also the data piece of it, of what's legally defensible as invalid traffic or not. And there's, they have every right to make those claims there. And so it's kind of filtering through that data to get down to the gross number that we send out to them in terms of a refund request is never what, is given back. There's always kind of a conversation back and forth to then dwindle it down to what is the legally defensible amount that should be credited back to the customer.
Now, you guys are doing this with technology. Could a brand even do this manually? Like, is it something they could even do, or would it require a ton of data analysis to understand what the fraudulent traffic is?
Yeah, I mean, the actual short answer is no. It's not something they could do on their own unless they had access to, they built the Pixel with the AI agents looking for the exact data points that we, are continually fine tuning to know what to be looking for when the traffic's coming through. So could it be done? Yes. Would it be difficult and labor intensive on the brand's part? Yeah, yes, it would be.
Okay, so this is probably why nobody's doing this, or it's just too data intensive. You really need technology to do it right.
That's correct. Yep.
So tell me a little bit more about how you guys identify bad actors, like in the data. What is going on that you are determining as fraudulent traffic?
Yeah, I think, you're looking at the IP address, you're looking at the geographical area that they're visiting from. We're looking at the duration of website visit. How long were they on the site? Was it a
Mm.
spoof, or did they actually stay and visit the website? Like I said, there's about 40 different data points that we're looking, and that's above that's more on the engineering side that would have the fine-tuned details of exactly what we're looking for. But at a high level, those are kind of some of the hot points that we're looking at with this traffic that's coming through.
Is there anything unique that you guys are seeing on Meta versus Google? That's where you guys are focused. Are there differences in fraudulent traffic that happen on those two platforms?
I would say Google has been a little bit easier to work with in terms of identifying the billing ways, simply due to the clicks being an easier thing to trigger versus how do you identify it on the Meta side. So I think the refunds we've seen are higher on Google. The preventative savings we've seen are higher on Google. So between the two, brands that are spending heavily on Google are seeing higher savings than those that are maybe more Meta focused.
So 3 to 4%. If I'm spending, let's say, $100,000 on ads a month, that 3-4 thousand a year. That's like 36, 48 thousand a year. That's a lot of money. It starts to add up, especially when you're getting squeezed in so many other areas.
Yeah, it is. And what's interesting for us is we're a card first company, right, Stephen? Like Dash.fi, we offer corporate credit cards specifically for digital advertising and shipping spend. And our main value prop is high cash back, high limits. And then this ad pay protection service is more a supplementary or a complementary product to that. So companies come to us for the upfront cash back on their ad spend, but then we add additional value by the incremental savings. So yes, I mean, 30, 40K coming back from the ad pay protection is significant, but then you couple that with what they're getting on the cashback side and it gets much more aggressive there.
So let's talk a little bit about ad spend. We look at people's financials. I would say for a low cost of goods sold brand, ad spend is quite possibly the highest category of spend that they have. Not uncommon to see a direct to consumer brand spend, 20 to 35, sometimes even more percent of sale on ad spend. Are you guys seeing any interesting trends around ad spend? Any interesting insights around ad spend as we're here in 2025?
Yeah, it's a great question. I think you're spot on. That's what we see on our end as well, is in between 20 and 30% of their revenue is what they're allocating to the ad spend side of things. What's been interesting, I'd say, in the last, call it 9 to 12 months, is the diversification of vendors that we're seeing come through on our cards. Whereas previously it was two, it was Meta and Google is almost where all the spend's going. Now we're seeing AppLovin or Stored or these different areas come in where they're advertising on different platforms. You've got, Pinterest, TikTok Shop, etc. So people are diversifying. I think that's a function of performance on Meta not being as lucrative as it once was for them, but also just trying to diversify the strategy and reach more customers across different areas. So
I read an interesting report yesterday about TikTok Shop. It said TikTok Shop is now as big as eBay. That was a little bit of a shocker for me. And I think that might be global sales, but there's been a lot of hype around TikTok Shop, and I wasn't sure how real it was. But when I read that article, I was like, okay, still eBay is microscopic compared to Amazon, but that's a big jump in terms of that ad spend. So yeah,
agreed.
ad diversification. Yeah. Any interesting platforms? So you mentioned Pinterest. Anything that's surprising to you guys besides the diversification?
No, not necessarily. I think what's interesting on our end is just the way brands are thinking about how they're paying for their ads. I mean, that's where we live day in and day out, is the way that they're actually paying these vendors for the advertising spend that they're running. And so I think, not sure if you want to dive into that today, but I think that's more where the interesting findings on our end have been, and where we've been able to kind of take a leadership role and kind of the education piece to brands in terms of what we're seeing, what's working, and how they can implement it in their own company. So.
No, let's go down that path. This is interesting. Tell me more.
Yeah. I mean, I think a couple different ways. I mean, prior to what we've been able to create, there were kind of two schools of thought. There were brands that were spending high enough volumes that a typical credit card, an Amex, Capital One, a personal guarantee card from the founders wasn't working, right? It didn't have high enough limit or capacity. So they switched over to invoicing terms with Meta and Google that was a little bit more stable for them. Or they were spending low enough where they were prioritizing the Amex Sky Miles or whatever they may have been getting, right? That they wanted to stick with the personal guarantee card. What that would lead to is, paying it off on a almost daily basis or bi-daily basis, right? And not really being able to take advantage of the float. What we've seen is there's Dash.fi as well as a few other cards in the space that are offering more flexible payment terms that allow a company to have the best of both worlds, that they can still have their negative cash flow conversion cycle and push out payment terms in a way that's profitable for them as a business, while capturing some sort of cashback incentive back to the company that can be used in multiple ways, right? It can be taken as personal benefit to founders to supplement income. It could be used to increase payroll, right? To hire new roles, or we've seen it, just sent back to the bottom line to increase EBITDA, to increase the valuation as they're looking as an exit opportunity. But it just feels the conversation shifted a little bit from companies are realizing that invoicing terms are great, but what is the actual amount of float you're receiving there? And is it worth sacrificing 2 to 3% cash back on your largest line item in your business?
Mm-hmm.
And vice versa for those that have the low limits, how one is there higher cash back and longer payment terms available to help them find a middle ground. So I think that's been the trend we've seen. It's been very exciting to be a part of.
What spend amounts are you seeing with your customers? I mean, I'm sure it varies widely, but are you guys working with people that are spending 100K a month? You know, how big of a volume of spend are you seeing on ads?
Yeah, I mean, starting point for us, we start work with companies once they're around the 100 to $150,000 a month on Meta and or Google is when we come into play. And on the high end, we have companies that are spending upwards of 15, 20 million per month running through the card, which is insane to me that there's that amount of spend going through a credit card was something that was very new to me joining this space, but
Tw-
it's being done.
20 million a month.
Correct. Yes.
So if that's, let me do the math. Let's say if that, just keep it easy. If that's a third of revenue, 60 million a month, that's like almost $1 billion brand, if I think right. 720 million.
Yeah.
Yeah,
Correct.
pushing. That's a huge amount of ad spend. Holy crap! All going on a card. Let's go back to the diversification of spend. Historically, you're right. I feel like it was Meta and Google. How much are brands spending as a percentage of ad spend on the others? Are you seeing, is it, it's probably really brand specific, but are you seeing any brands that are spending a lot of money, like more than 10% of ad spend on non-Meta Google channels?
And there are some. Yeah, I would say the majority of clients we work with, 70 to 80% of the spend is all on Meta. And then
Hmm.
another 20 to 30% is broken up pretty evenly. Like if I were to take a step back, I think when I first joined, it was Meta 70, Google's 20, the other 10% spread across smaller channels. And now I'd say it's more Meta 70 and the other 30% is split very evenly across the other channels with Google taking a smaller spot there. That's what we're seeing on our end, at least across our customer base. And they're ebbing and flowing who they test it with, what they do. I think especially the very successful brands we're working with, they are always pushing the boundaries, testing new channels. They're iterating consistently to see what's working.
Let me pull on something you said. So, did I hear right that you guys are seeing Google spend decline?
But yes, and that's obviously on our card. Part of that's because Google, if I now that I'm saying it out loud, part of that is because Google stops accepting card as a form of payment, right? So there's still those that
Oh,
are so our data is going to be very heavily skewed that way, right? There's still those
okay.
that Google allows to pay with the card. So take that in consideration with that comment. I should have clarified there. So,
No, that makes sense. Um, Anything that you feel like is accelerating that you guys are seeing in the data, or is it because I feel like e-commerce, they're always like looking for the next thing, and there's last year I felt like there was a ton of hype around app 11. I'm not sure if it's materialized or not. And this year, there's been a lot of buzz. There's also been a lot of buzz about TikTok Shop. And seeing that article, I was like, okay, maybe the buzz is real. Um, are you seeing anybody starting to accelerate, or are these newer channels still kind of in that emerging status?
I'd say App Lovin is still very much part of the conversation. I think they've opened up their, the general public at this point instead of the beta model where more brands can get in. We're seeing the brands that were previous in it continue to double down and spend more there. We're seeing other brands start to join in. So I'd say that's the one when we think of the App Lovin and TikTok are the two emerging channels that we're seeing in terms of where brands are spending outside of Meta.
Okay, yeah, that seems about right. What are you guys thinking about? I mean, I know it hasn't really emerged, but it feels like next year there's a good chance we're going to see ad programs on AI. I haven't seen anything tangible. I mean, the biggest thing I've seen is that ChatGPT is facilitating in-product checkout, and I've been watching really closely. And there's nothing on the roadmap, but I read an article a while back that said that it looked like they were hiring for an ad platform team. I've got to figure it's only a matter of time before you're able to advertise in these platforms. Have you guys had any thought or have any inside scoop on AI related advertisement, or are you in the same boat where you're just kind of waiting and watching?
Yes, I would say waiting and watching. No inside scoop. I think it's definitely something that's top of mind for us and something we're looking for to be early adopters there, right? But yeah, I think you're right. It's a matter of time. Huge monetization opportunity for them to to monetize on the advertising front. I think things I'm seeing, same as you, just in the D2C community, are people optimizing their SEO to be able to rank higher in the chat GPT responses, et cetera. So I know brands are prepping for it as well, and like the natural organic side of things. But no, I wish we did have an inside scoop there. It'd be nice. So,
To me, it just seems like the logical next step, because I've been watching a lot, and the term I'm hearing is GEO, generative engine optimization. And really what it looks like is just instrumenting your listings, being like, I co-own a brand, and my operating partner, we talk about this almost every week. And he's like, there's like a ridiculous amount of parameters you can put on a product listing. And our thesis based on what we've read is, you could just keep putting stuff on there and on there. And that's the organic side of things. But to me, having an ad platform, it just seems obvious. I read about how much OpenAI is losing in terms of money. So it's like, surely they're going to come up with an ad platform at some point, at which point it'll be really interesting to see what happens, because the amount of traffic that's going to these AI chatbots, forget in-product checkout. You could just do ad platforms, and you're probably going to see a tremendous amount of income in those areas, as long as they do them right.
yeah, it'll be very interesting. And then the next question on that is attribution, right? What are the solutions that help solve for actually attributing what's coming through ChatGPT advertising back to your storefront, et cetera, and measure performance to know whether or not it's worth investing in, right? So lots of
Yeah.
questions.
Well, you're already seeing attribution. We looked at our brand, and you are seeing attribution coming from ChatGPT. I'm not sure exactly how that's being done, other than maybe just looking at referral traffic. Once you get in product traffic, in-app checkout, that'll be really easy to attribute. I'm assuming they'll be able to see, but again, the attribution that's like one of the mysteries and also controversies, I think, in e-commerce, because these platforms like to take a lot of credit for a sale, and you've got the emergence of these third-party tools that try and independently give attribution. It's just a very interesting part of the e-commerce ecosystem.
Agreed. Yeah.
Any other interesting trends around ad spend that you guys are thinking about, talking about? Obviously, we've talked about the fraud, we've talked about some of the patterns. Anything else that you guys have been a surprise or an interesting insight as of late?
No, not necessarily. I think the one other thing that I touched on a little bit, that again, that more biased because it's what we do day in and day out, is just the way that the rewards are being used. I think is something that's interesting to me. Most companies, they've got the travel points, which are great that they're leveraging, but being able to one switch to true cash back and then leverage that cash back for meaningful business expenses. It's what's been interesting to me, and that's all customer led on our end, right? It's interesting to see as we sit down and kind of strategize, hey, here's your rewards, how do you want to use them, how can we help you, and to hear what they're coming up with of the, it can be fun things like purchasing season tickets or box seats or whatever it may be, funding lifestyles, which are fun to hear about. But then you hear hey, we're able to hire XYZ role, or we were able to increase our ad budget by 3% because we just put the card back on file in the ad account and ran it there, which led to X amount of revenue. Or just every company approaches it differently. But for me, I find it fascinating when they're plugging it back into the business and we're able to see like the real impact the cashback is making, something that you couldn't do with like a point or something like that. So I think that's the only trend we're seeing, and we're trying to take our learnings and how do we help teach the market of what are some of the best practices. But yeah, that's, I think we've hit on where we play every day.
No, that's a good point. I've got to tell you, because we support them on the accounting and the finance, and I've found it really interesting that sometimes e-commerce operators, they get so focused on the benefits that they don't always think strategically about the business. It is a nice fringe benefit. I won't get wrong. I'm a business owner. I own two businesses. The fringe benefits of card spend are awesome, but I would argue that cash flow is one of the biggest challenges of every consumer product business, because of the long inventory lead times. Sometimes if you're, with payouts, it's fairly quick with Shopify. It's usually about 2 days, about 14 days with Amazon, up to 14 days. And then when you get into like wholesale, it can be like 30, 60, 90. And I feel like your card spend as a cash flow lever is underconsidered. People are more quick to go out and get expensive debt, like, oh, let's go get a Shopify loan, than take a step back and say, yeah, this, points-based system is nice, but perhaps I could put more cash into the business using a different card strategy, or just using cards at all, right? I'm like, lever number one, leverage your cards, leverage the terms as long as you can, because cash flow is a challenge for every brand. And I just think they don't always think through the full picture. Is it about, are you chasing ad spend, or are you chasing enterprise value? And enterprise value comes through profits, through cash flow, things like that.
Yeah. Yeah, I think you're spot on. And I think the way we've worded it as well is if our cashback ranges, depending on the amount of float that you're looking for, are going to be in between 2 and 3%, which is top of the market. And if any brand were approached and said, hey, would you like a 2 to 3% discount on your meta bill? The hands in the room would go up immediately, right? But it's interesting how many brands are still hyper focused on, well, I'm optimizing my points to get this many travel to fly first class, et cetera. And we always say, hey, leverage your travel cards, max out the benefits, because most of them have interim. Like, there's a way to play both. We're not saying you shouldn't enjoy the fringe benefits, but at the long run, you're leaving money on the table for the business if you're hyper focused on that and not the enterprise value. I think you're spot on there, Stephen.
Well, you've been in e-commerce for a while. What year did you start with e-commerce tech?
2020.
2020. We're like in a different era of e-commerce. 2020, I mean, I would say so we got going in e-commerce probably about 2016 is when we started focusing.
Awesome.
So we've been around. And I think about it, there's multiple eras, with the COVID peak being like an era onto its own, right? The hyper spending, the high valuations. But comparing 2020 or even 2019 to 2025, it's a totally different game. The margins are tighter. The costs of lending are higher. The ad, we're talking about ads. The ad efficiency it's not even the same equation from 2020 to 2025. And I feel like brands need to be, they're going to have to really look at every lever of profitability that they can, because it's just not easy money anymore. It's now roll up your sleeves, grind it out to profitability industry.
I think you're spot on. I think that's definitely what we're seeing, especially those that have maybe been on invoicing terms in the past are realizing just how much money is being left on the table for very relatively, like the difference of leveraging a card on, net 30 terms versus invoicing and averaging out to net 45. Like, keeping the cash on hand for 15 days more is not earning them incremental yield, right, in a bank account. And so that switch has been very solid move for them. I think something I'm noticing as well, just selling into companies, in 2020 versus now, is buyers are very savvy. They're very savvy. They're very educated. Companies are streamlining their tech stacks. They're only bringing on softwares or services that are truly value add and are moving the needle. And so that's why it's been so fun to be a part of this team here at Dash and Build It, is just knowing the value we're adding is real and significant. And I also don't take for granted the companies we get to work with. They're companies I see in online every day, companies I see in the store when I go, and to know that they place their trust and confidence in me and in Dash.fi is no small thing, and pushes us to make sure you have to come with your best foot forward, because they're not just bringing on any vendor, whereas 2020 may have been a little easier to get into companies.
Yeah, I mean, I think about it in a lot of ways. I feel like e-commerce, it's just a different form of retail in terms of the financial profile, right? You may not be spending as much money on real estate, but you are probably spending more on customer acquisition, although there's a lot of crap brick and mortar retail out there. But I just don't, in 2020, it was almost like, hey, this magic elixir of money. And now, I mean, even looking at Amazon, most of their profits are coming from AWS, as a percentage of, profit to sale ratio. They're making a lot more margin off of AWS than they are off of Amazon.com, the store. And I think there's some inherent advantages of e-commerce, but we're just in a different era where it's going to be a fight. It's going to be a slog. You have some intelligence you don't get from brick and mortar that allows you to understand the consumer better than ever, but it's not the gravy train that it was a few years ago. And I think I'm with you. I think those who are going to survive are going to be more savvy. They're going to be more operationally and financially intelligent than they ever were. And we're probably going to see a lot less of those. You see those guys like on Facebook ads and YouTube ads that are selling a course how to make a lot of money on e-commerce. Like, I just feel like that era is quickly coming to an end.
Yeah, I think you're spot on. The operators that are winning are true operators, and they're iterating, they're diversifying. We talked a little about diversifying ad budgets, where they're diversifying from being only e-com to branching it into wholesale to even having retail, representation. They're diversifying payment methods. I mean, they're becoming true structured businesses, which you can appreciate on the finance side as well. When you look at the balance sheet P&L, what's leading to that. Yeah, we're kind of seeing a separation of those that rode away versus those that built really solid foundational businesses.
So we talked a little bit about how you guys are solving the problem. Dash.fi, what was the background there? Was it just did your founder see there's this problem and decided, hey, I need to go solve it because only technology can do it? How did you guys get into doing what you guys are doing?
Yeah, we talked about attribution earlier. So Dash.fi actually started as an analytics and attribution platform for media buyers. That was about 5 or 6 years ago. Zach, our founder, Zach Johnson, kind of realized there was a gap in the market in terms of how people were paying for their advertising spend. Like we were talking about, they were either on invoicing or they were using a personal guarantee, Amex, or whatever it may be. So he got into an accelerator with Visa, built what is the Dash.fi card, and then from there scaled that for the last 4 years. And then about a year ago, just over a year ago, again, saw a gap in the market with the bot traffic, kind of the different litigation and reports that were out there, took his analytics and attribution background and built this product, which we've titled Ad Pay Protection, this pixel that helps identify, and rolled that out in conjunction with the card. So it's been interesting how our roots kind of led to the product that's helped propel a lot of our growth, but that both products, I mean, technically the pixel doesn't have a lot to do with the card directly, right? But they're both focused on helping companies maximize the return they're getting on their ad spend from a savings level. And that's where we found the synergy there. But yeah, that's kind of where we started, how we got where we are and where we're going.
And you were telling me before we started recording that you guys started shifting your focus from capturing refunds to just avoiding the fraudulent traffic altogether. So you guys are trying to get in front of that instead of waiting for it to happen.
Correct. Yeah, I think as the refunds, we're still seeing some success there, but with response times delaying and things like that, it was how do we add more immediate value to the customer, and those preventative audiences or exclusion audiences, very easy, immediate, simple way to be able to show a brand immediate impact on their ad budgets.
Is there any directions that you guys are thinking about that you haven't pursued yet? Like any interesting problems that haven't been solved yet that you're wanting to solve, or are you guys just heads down trying to continue to execute on what you're doing?
No, I think we're always Zach's a true visionary founder where he's always thinking of problems that haven't even crossed my mind yet. So without sharing too much, I think you've alluded a little bit to the shipping solution we've come out with. You talked about AWS. How do we solve these same problems that are in the AWS side of the cloud service side of the world? Like, there's a lot that we're thinking through, and then the AI component as well. But yeah, we've got plenty in the works, which is good.
That's exciting. Well, I think it's great to have solutions like what you guys are doing. Like I said, this year has been another year of margin squeeze with tariffs. And I think brands need to be looking at ways to claw back margin wherever they can. And it's awesome to have people like you out there in the industry that are trying to find ways to help brands claw back that margin. If somebody wanted to connect with you, what's the best way to do it?
Yeah, first off, appreciate that, Stephen, and appreciate the conversation. I've really enjoyed this today. I think if people are interested and wanted to learn more, I'm on LinkedIn, Kurt Bell, or my email, kurt@dash.fi, or the learn more form fill on our website. But would love to chat with anyone and everyone that's interested and learn a little bit more.
Awesome. Kurt, thanks for joining us today, and keep up the good work.
Awesome. Thanks, Stephen. We'll talk soon.
Today's episode is brought to you by Ledger Gurus, your go-to team for e-commerce accounting. We handle everything from keeping your books in order and tackling sales tax to managing your inventory accounting and even acting as your fractional CFO. Basically, if it's about accounting, we've got it covered so you can focus on growing your business. Head over to ledgergurus.com and see how our team can help you level up your business today. That's LEDGERGURUS.com.